Good morning, and welcome to the New York City Comptroller's Annual Investment Manager Conference. I'm Cara Wallace, Chief Diversity Officer, and it's wonderful to have all of you here with us today. Let me start by thanking the Teachers Retirement System for opening their doors and allowing us to hold this conference here again this year. I'd also like to acknowledge the trustees from the city's pension systems that are here with us today. We appreciate your leadership and oversight. And we also appreciate that for the third year in a row, over 700 people registered to attend. It tells us that we need to continue being proactive in our outreach and communications with all of you. Our goal is to ensure that those of you doing business with us currently and those wanting to do business understand our mission and priorities. This will help you compete successfully on a level playing field, and when you win, you'll meet and exceed our expectations. We have a compact half-day planned for today's meeting, and the top priority is for you to hear from and network with key folks from our Bureau of Asset Management, our consultants, as well as each other. You'll meet our Bureau of Asset Management senior leadership team, which has several new members since last year's conference. And of course, you'll be hearing shortly from Comptroller Stringer. Please take a look at the agenda. As you can see, the program will go straight through, and then we will break out into the networking sessions, which will be held on this floor and the 19th floor. And you'll see inside of your program the specific rooms for each asset class. This year's meeting highlights the transformation happening inside the Bureau of Asset Management. We've titled it Building a Stronger Future because under Comptroller Stringer's leadership, we are rethinking how the Bureau of Asset Management does business. For too long, too little attention has been paid to the way our city manages its investment operations. In the past, there was a sense that nothing could be done to cut through and streamline an intractable bureaucracy. But not for Team Stringer. Today, we are re-engineering every process and procedure and bringing our investment operations into the 21st century. And needless to say, we are working closely with the trustees of all 5 pension systems to address these serious issues. Today's conference also highlights the importance of diversity in the work of the Comptroller's Office and the daily life of this great city. Excuse me. Last year, several of the funds adopted a policy proposed by the Comptroller to consider the diversity of a firm's leadership and investment professionals and their policies and procedures as a factor in evaluating and selecting investment managers, consistent with fiduciary duty. We've gone through our first round of collecting baseline data, and we found some great standouts. So today, 4 firms will be receiving the first ever Comptroller's Diversity Practitioner Awards. But there's so much more to do. We've got to expand our efforts to level the economic playing field for all New Yorkers. We've got to put economic opportunity at the heart of our efforts to manage this city, because that's how you guarantee strong fiscal performance. New York is changing at breakneck speeds. And Scott Stringer knows that the key to our vitality, our most important resource, is the great human intelligence and energy and the diversity of this city. He's made it clear that the best way to guarantee the long-term stability of our pension funds is to build an inclusive economy. Smart management and equal opportunity are the foundations, the heart and soul of a comptroller's office that is transforming this city and lifting up all New Yorkers. That's how we're building for the future, today and in years to come. It's my great pleasure now to introduce to you New York City Comptroller Scott M. Stringer.
Thank you and good morning. I just want to start off by just saying to Carol Wallace, the city's Chief Diversity Officer, that you have done an amazing job in so many different levels in this city. And to be introduced by you today is really a true honor. Give it up for Carol Wallace. And I want to welcome everyone to the 2016 Investment Conference, Building a Stronger Future. Before I begin, I just want to acknowledge number 42, the man who was served as controller for 8 years and has been a great friend and mentor to me for such a long time, and that is Controller Bill Thompson. Give him a big round of applause. I'd also like to say thank you, first and foremost, to all of our trustees. They do an amazing job. I want you to give them a big round of applause because we could not accomplish what we do without them. I see Pat Stryker, and one of our premier trustees is the public advocate, Letitia James, who serves on NYCHA. Please give Tisha a big round of applause. And I have to acknowledge the first deputy controller of the city of New York, Elena Gilligo. Please give Elena. She puts up with all of us. I also want to thank Michael Mulgrew and the UFT for allowing us to host this conference again this year, and also for fighting every day to strengthen our city's public school. We have to give them a round of applause. We use their room, and thank you. Couple of more thank yous. I want to thank the staff of our Bureau of Asset Management for their constant attention to the best interests of our retirees. Give BAM a big round of applause. They do a great job. And specifically, I want to thank Susanna Vickers, our Executive Director for Pensions. I want a round of applause for Susanna. Susanna has worked with me throughout my entire public career. She started at the age of 12, and she wanted you to know that. And I also want to thank somebody, but really also to once again tell you that when I got elected controller, the most critical job that we knew we would fill would be that of the chief investment officer. It is not an easy job. It's a complicated job. This is a big pension fund, 58 trustees. He has really embrace this job in a way that few have, and I think our pension system is stronger because of him, and I would argue that his presence today is having a profound impact throughout the United States of America, given the work that we're doing with other pension funds. Give a warm welcome to Scott Evans. You're going to hear from him later. I want to thank everyone for coming, and I want to start by saying today, the New York City economy is in strong standing. We're in the 8th year of recovery since the Great Recession, and we've added more than 550,000 new jobs in those years. But from the beginning of my time as controller, I've been focused on strengthening the economy of all of our neighborhoods. That means enabling our minority and women-owned businesses with tools to win more city contracts. It means cutting the bureaucratic red tape that holds back so many of our small businesses. And it means ensuring that we use every resource at our disposal to add permanently affordable housing. The way I see it, our city will only thrive when our economy is lifting all boats. And today, so many New Yorkers are still not feeling the impacts of our recovery. 57% of the jobs we've added are in low-wage industries. And our next generation, we call them the millennials, but they're really our children. They're actually making 20% less today on average than their counterparts did way back in the 1990s. We have a long way to go before we can say that all New Yorkers are better off. But in the meantime, our office is working hard to grow our economy any way we can, namely to maintain the good health of our $160 billion pension funds. Because every week that I travel around this city and I meet the men and women, teachers, policemen, firefighters who rely on those pension checks, I also get an opportunity to listen to their stories about their years serving New York City and now their time in retirement. And that's what motivates all of us every single day, because our work is not just about dollars and cents. It's about growing the value of our funds to benefit the hardworking people of this city. It is a tremendous responsibility. It is very important. Now, we all know, you all know, that in order to do that, we have to operate a system that is ethical, transparent, and efficient. And that's why when I took office, we undertook an ambitious reform agenda to transform the Bureau of Asset Management. I'm proud to report that with each passing year, in close collaboration with our trustees, we are making progress to achieve it. We started by hiring our office's first ever Chief Senior Risk Officer, Chief Compliance Officer, and Chief of Internal Auditing. We work with our trustees to enact a long overdue ban on placement agents. We took on management fees at our funds and across the country. We began requesting staff diversity information from all investment firms that want to work with us. But even that wasn't enough. We had to go deeper to create the fundamental change that would propel our funds forward. So we hired a leading pension fund consultant to conduct a top-to-bottom analysis of the operation and management of BAM. It was the first of its kind since 2002, since Bill Thompson. And let me tell you, we learned a lot about how we can enhance our due diligence and increase efficiency in how we do business. You're going to hear much more about key impacts emerging from the report later from Scott Evans. But I want to emphasize now that on top of commissioning the review, our office chose to make its findings available to the public, because the 715,000 employees and retirees who depend on our pensions have a right to know how we're doing business. And they deserve to feel confident that we're acting as efficiently as possible. Now, thanks to a major step forward by our trustees, the way our boards meet and make decisions is far more efficient than ever before. In December, the 5 boards approved for the first time a common investment meeting. Until then, our funds were meeting 54 times a year. Now, trustees all come to the same table for a fraction of the meetings we used to hold. And I want to be very clear, this change is far more than an administrative simplification. It now enables our staff to spend more time overseeing our investments and less time sitting in the same meetings doing the same thing over and over again. What's happened is that allows us to do real due diligence. And we believe that in the long run, that's going to generate greater long-term value for trustees, retirees, and taxpayers. I really want you to give a round of applause to these trustees. They made fundamental change this year. Give them a round of applause, please. So this year, we've continued our momentum and even picked up the pace on improving the pension system. But we also understand that to truly see the impact of these reforms, we need a voice in the decision-making process of the companies we invest in. Last year, I told you about the Boardroom Accountability Project. It was our national campaign for proxy access to allow large, long-term share owners like the City of New York to nominate independent board of directors using the company's ballot. Well, 2 years later, the response in the investment community has been loud, sustained, and overwhelmingly positive. When we launched, only 6 companies had meaningful proxy access bylaws. Today, The number is 250, including nearly 40% of the S&P 500. In just 2 years, we have not only changed the debate on proxy access, we have impacted the landscape of corporate governance. And you know how we did it? We did it in coalition with public pension funds all over the country. It has been an extraordinary campaign because diversifying our boards, just like diversifying our assets, is a critical step towards ensuring long-term strength of our pension funds. Now, you may remember that diversity was the cornerstone of last year's conference. But this is not about checking a box. This was not about a short-term commitment. I'm happy to report in the last year, we've allocated another $500 million to emerging managers in private equity over the next 2 to 3 years, and instituted a formal graduation policy for private equity emerging managers. On top of that, we've proposed a graduation policy to empower successful, small, new managers, including MWBEs in the public markets. And this year, our proposal passed. Now we can reward and retain the managers who deserve our business. We are not playing around. We are not sugarcoating anymore. We are going to fundamentally transform this process so that everybody has a real seat at the table. Now, I know we have a long way to go, and we can only do what we can do in the 3 years. There's term limits, so I got to step it up, right? But we are committed to doing this and working with all of our trustees. Because at the end of the day, this is what it's all about. Protecting the people who built this city while maintaining strong growth for our teachers, policemen, firefighters, the city workers who keep this town running every single day. That is why we do this work, and that is why we believe managing the 4th largest pension fund, public pension fund in the United States, and the 14th largest in the world, means that we have to create a system and a process by which other pension funds will follow, and that's what we're doing. So I want to thank all of you for being here. This is going to be a really great show. You're going to learn a lot, learn about what we're doing, and we're also going to have an opportunity to learn from you. So before I step down, for the first time, we want to make a very special presentation. I'm honored to present the first annual Controller's Diverse Practitioner Recognition Awards to recognize investment managers that have demonstrated a strong commitment to diversity in their hiring, their executive leadership, and their compensation policies. You should note this award doesn't come with any money or expectation of allocations. Now, you knew someone in BAM wrote that line, right? They said, just be very the lawyer. Scott, this was a lawyer language, right? He's nodding, yes. But this is just simply an acknowledgement of the progress by a few managers that we hope will inspire the rest of the field. So I'm going to ask them to come up. Our first awardees, the drum roll, please. Come on. For private markets managers, I'm pleased to recognize Standard General LP, Sue Kim, and Steve Usher. Please come and receive this award. Give him a big round of applause. The awardees will be featured prominently in the next issue of Bond Buyer. Yes, we read it. Okay, the next award, the MetLife Investment Management. Let's welcome Nancy Abbott and Scott Hirsch to the stage. Nancy Abbott and Scott Hirsch. And for public markets, I'm very pleased to recognize Amalgamated Bank, Tony Ann Sforza, Eleanor Innes, and Lisa Steglish. Please welcome Amalgamated Bank. These managers have really distinguished themselves as leaders in promoting diversity, and I just want to say thank you again. In future years, we're going to recognize more managers that share our commitment to diversity in the interests of our pension funds and our city. But before I step down, I wanted to save the best for last. Well, no, I like them. They're good. Let's welcome State Street Global Advisors. Welcome Gregory Balwitz to the stage. One more award. Give all the awardees a big round of applause. All right, so the person who has managed this money and managed the Bureau of Asset Management like nobody's business, a great friend. He and I bonded when we first met. We had two things in common. We like diners and we like the New York Jets. And we are still friends. So, ladies and gentlemen, the Chief Investment Officer, Scott Evans.
Thank you, Scott. As you know, when you're trying to make change, as we've been trying to make here in New York City in the Bureau of Asset Management, you can't do it unless you have strong people behind you pushing. Scott Stringer has been personally involved in a lot of these reforms that we talk about. He's made it happen. He doesn't just show up for the press appearances. He's in there working the room and making all the tough decisions, and he has had our back every step of the way. So, Scott, thank you very much for all your help in these early reform efforts. I'd also like, if you'll grant me just a second, time to thank our staff, the support staff for the Bureau of Asset Management, the special events staff for the Bureau of Information Systems and Technology, and the BIS staff themselves, and one person in particular. Last night, as I was going through my slides, I found out that 2 slides, the numbers didn't add up. And so I sent a little email, and this poor woman was up until 1 o'clock in the morning, Antoinette. So Antoinette, she's back at the office, but thank you. I hope that all the slides now add up. So I kind of view this as a partners meeting. We have, as you'll see, a large pension fund, $163 billion, and all of it is managed by outside managers, except for a little bit that we invest in Treasury bonds. So we can't do this without you. We can't do this without investment professionals all across this country, from all asset classes, all perspectives, out there in the markets, looking to add value for the 715,000 people who've worked for the city of New York. So on behalf of our staff, thank you for everything you do. And for those of you who would like to work with us, and there are a few of those in the audience as well, we've tried to tune our remarks so that you'll understand us a little more, what we are, where we come from, and how we look at things. So why don't I get right into it? This is the lay of the land. We have 5 systems. There's teachers, employees, police, fire, and the Board of Education. Together they make up $163 billion. We're the 4th largest public pension fund in the U.S. at the moment. Last 10 years, I got to be honest with you, have not all been a lot of fun. We've gone through the global financial crisis. The past couple of years have been like watching paint dry in the markets. There's nothing happening, and we need 7% in order to keep things fed. But interestingly, and those of you who are down here won't be able to see it, you can see it there. We've earned 6.9% over the last 10 years through this dreary period, one of the most challenging periods in global financial history. We've earned the bogey that we have with rounding, 6.9%. We're 70% funded, and the actuary has us tuned with extra contributions every year to catch up over the next 18 years. In New York City, unlike many large municipalities and states, is making those extra contributions every year, some $10 billion coming from taxpayers into the pension funds every year, and that's going to help us catch up and be fully funded so that we can fully support the promises that we've made to the 715,000 people that we support. In looking at the portfolio itself, with thanks to the Wilshire Group who've caused us to think of things this way, we have about 70%, 69% currently, on growth assets. These are asset classes whose job it is to bring in return. And we have the pedal down pretty far in order to create that. But we have a diversified set of return characteristics, which I'll get into. And then we've divided the rest of the portfolio as a shock absorber to help us with the volatility that's created when you're trying to get growth, both to help us in periods of deflation and inflation. And just to give you an idea what I mean by this, if you look at the, this is a slide that didn't add up, by the way. When you look at the growth part of the portfolio, the big blue piece is U.S. equities. That's the workhorse in any U.S. pension fund. The second largest would be our EAFE exposure, developed public equities. In red, you have emerging public equities. In green, you have private equities. In orange, high yield fixed income, opportunistic fixed income, opportunistic real estate, hedge funds, which are in 2 of our 5 funds now, and convertible bonds. That makes up the offense in our portfolio. When it comes to defense, I'm sorry, we're having technical difficulties here. Put it on its own. Okay. I have to tell you that since the 3rd grade, this is the first time I've ever been in a room where anybody's had any trouble hearing me speak. This voice always got me in trouble as a youngster. Strangely, even when the teacher was facing the chalkboard, she could pick me out. Anyhow, in terms of deflation hedging, we've got investment grade bonds, mortgages, treasury securities, ETI investments. These are economically targeted investments. They're mostly mortgage securities here in the 5 boroughs. They're backed by the state for the most part, guaranteed by the state. And then we have other fixed income, which is a catch-all group that's an assembly of things. In inflation hedging, we have treasury protected, inflation protected securities, core real estate, both REITs and private, bank loans, short-term investments, and our infrastructure investments. Infrastructure is small now, but it's a growing presence in our portfolio. So that gives you a sense of what we invest in and the general proportions. We have a little less in alternative assets than you might see in other public funds, because in New York State, we're bound by something called the basket clause that limits our ability to invest in alternative assets. It's more complicated, of course, because it's a state law, but that's the gist of it. I want to assure you, we just gave away some diversity awards. We believe in diversity, and we're trying to approach diversity from different perspectives, to look and value diversity in every one of your organizations, whether you're a minority-owned enterprise or not. But I want the minority and women-owned businesses out there and across the country to understand we are not giving up our focus on MWBEs, our belief that we should constantly be on the lookout for strong and emerging managers, because it's in many ways the lifeblood of new thinking in our portfolio, and we will not give up the hunt for MWBs. We found $11.2 billion worth of investments to make. That's 6.5% of our portfolio. Scott mentioned that we're continuing to find new ways to allocate. And I want to spend a little bit of time telling you where we are in MWB investments, and pay attention particularly to direct investments and indirect investments, because the graduation policy that Scott mentioned is going to become important here. Now, you're not going to be able to see the bottom slide in the middle, but hopefully you can see it over there. I'll point to it. Unfortunately, not for you, but for our record keeping, there are 498 relationships that we have between direct and indirect managers. Now, I got to tell you, that's too many, and we're continuing to try to cull it, and we have a much narrower focus. But we have 498 relationships, 271 direct. And if you look at public equity, we got 67 relationships. 40 are non-MWBE and 27 are MWBEs. So it's a pretty good representation. But down here, only 22% of those relationships are direct relationships. Most of what we've done is indirect through fund of funds. Now, we are going to continue to use fund of funds as an extension of our staff. We're going to use them a little differently as we move forward. We want them to help us prospect for young managers, emerging managers, strong managers, so that we can reach in and invest directly with them and can contract directly with them and establish a relationship. When we do that, suddenly they become known to every major consulting firm in the country, because we employ every major consulting firm in the country, I think, except for Mercer, and I'm told the DC plan has Mercer, so we've got them covered. In private equity, this is where we have too many relationships, as you can see, and we have a much tighter lens. But we got started on emerging managers some time ago when Alex Donier, who's now the head of private markets, came to us from Washington. He started a direct emerging managers program in private equity, and we've begun to grow that. We didn't have the constraints of the graduation policy. The constraints of the procurement rules in private equity. And so we've been able to build a number of direct relationships in the private equity space. It's only 17% and climbing, but part of that is because this number is coming down as we narrow our focus and have bigger allocations to fewer firms. Okay, so a little bit about the graduation policy. It was passed in 2016. It allows us to directly contract with firms, and when we do that, we don't have to go through the procurement rules, and the contract is good until we do our next procurement in that particular asset class. So that's the window that it gives the smaller manager to get to know the consultants and to work with us in a direct fashion. I have my staff beating the bushes out on planes, talking to all prospects that we have in the fund of funds today, looking for candidates to graduate. Okay, I want to puff out our chest a little bit, if it's okay. It is our conference, so we'll do that. And that's to talk about our MWE brokerage program. Now, this was well underway when I got here. And okay, note to self. I'm just gonna stand over here. That's okay. Where the hell was it? Okay, so we have an MWB brokerage program. Now, what does that mean? Well, we all know that the rules, and quite rightly so, are that the managers that we employ choose their own executing brokers, and they go for best execution. They go out there and they find the best execution they can have. They're obligated to do that, and nothing we will say or can say should have anything to diminish that. However, trading's a relationship business, and it's possible to find best execution in a number of places. And it's funny, but the brokerage community, despite all the technological advances, people tend to stick with the folks they know. And when they don't know minority and women-owned enterprises, it's tough for them to break into that process. So we have come in and said, we think it's possible to find best execution in the following proportions: 25% of your volume in U.S. equities, 20% in non-equities, et cetera. And lo and behold, 87% of our managers have found a way to do this. Now, we don't recommend any specific brokers. We do employ a consultant to screen brokers, to be able to have a list of brokers to show to you that we think are capable of providing best execution. It's up to you to decide. But we're now at the point where almost everyone is finding that they can do this, that works for us. And we think that's terrific. It was not always so. As recently as 2013, only 50% of the folks that were working for us, about half of the people that were working for us, were able to find MWBE relationships at the proportion that we had suggested. We haven't changed the proportion. We're up in the 90s, and I think we're there. We'll never be to 100%, but we'll never stop trying. And I appreciate the seriousness with which all of our partners have taken this effort. We have not avoided best execution at all, and we have now found a lot of opportunity to work with the minority community on brokerage. Okay, now I want to talk about our organization, because we've been busy, as Scott says. We made a lot of changes, and I've brought some people in to help me with those changes. You're going to hear from Alex Dunier, who's our group head of private markets. Like I said, Alex started on the emerging manager program in PE, had a long career at Merrill Lynch. Before that, was quite simply the most outstanding due diligence manager I found when I came here to the Bureau of Asset Management. And it's no surprise that he's risen to be one of my top two lieutenants. The other one is Mike Haddad, who came to us from the hedge fund world, worked for George Soros, worked for Bruce Kovner at Caxton and a number of other places. And Mike is overseeing our public markets group, which includes public equity, public fixed, hedge funds, and opportunistic fixed income. And so those two guys have helped us professionalize, standardize, and move the Bureau of Asset Management forward to become a true investment organization. We have a full investment committee process, standardized due diligence processes. We're integrated with risk management and compliance. These guys knew how to do this before they got here, as did I, but they have helped us begin to work together as a machine. And so when we come out and visit you, whether we visit you in public equities in Dallas or international equities in Edinburgh, we are having a standardized process, standardized due diligence that's going to come into our investment committee. It will come to our board with a standardized process so that they can easily compare and contrast the different managers and your strengths and weaknesses. In red, we have Kara Schnapper, who comes to us from running the operations and technology groups at TI-CREF and at JP Morgan Asset Management before that. And Kara basically has come sort of as an inside consultant, and Kara's in the room. Kara, you stand up. She is the person to make Funston happen. So we did this Funston report that Scott mentioned. Don't say Funston and step on this at the same time. There's just a tremendous amount of work we have to do with our own plumbing that needs to be done. Kara has racked and stacked everything, working with David Jeter, who's our long-serving Chief Operating Officer, and has helped us to bring the Bureau of Asset Management into the modern age. Now, I'm not going to talk about all of that. We already hit the world with a 398-page report. But I am going to talk about that part that I think is really relevant to our relationship. And I'm going to get into a little detail very briefly, and then we'll move on. So, excuse me. Accident looking for a place to happen up here. Okay. We have made a big change in how we're reconciling public managers' information. And I sent a letter out to all of your operations teams, those of you who are working with us today, saying that we needed the information 3 days after the end of the month. It's standard in the industry. It's now standard at the Bureau of Asset Management. We really can't work with managers that can't meet this obligation. This helps our data stay clean throughout the whole process if we hear back from you in 3 days. So we've made that change. It's on the heels of a big change that we made in the private markets, where we've asked everyone to send us your capital call and distribution notices or your invoices in a standardized fashion. We use the OPA template. That's helped us gather much needed transparency about the fees that we're charged and the other expenses that we have. So both of those very important. In terms of invoice processing, we did a little survey of our vendors, and we said, what are the big problems that you're having with us? Over and over and over again, they said, we'd kind of like you to pay our bills. So when we send you an invoice, we'd like to get paid back. So, 3 months later, I'd have the follow-up meeting, and what I get back from you is, we really mean it. When we send you an invoice, we'd like to get paid back. And Scott, I know you started in 2014, but we still have bills from previous administrations that haven't been paid, and we look back and there were bills that had gone back a long, long time. We were not doing this on purpose. We were dutifully trying to process these things, but our process was not clean. It wasn't sound. And there's one simple, from your perspective, way to solve this problem. Write down this website and send the invoice here. It's an email address. Send the invoice there. The invoices, believe it or not, are going to 25 different places, and they're on a one-way trip throughout the controller's office until they find their way to people that can pay them. So if you send them there, we are aiming to get them paid in 18 days. And I know that sounds like a stretch to some of you, but we have proved that we can do it. The other thing that people say to me is, what's up with the management cap? We have a fee. The fee is a percentage of assets, just like it is everywhere else, but there's this cap that we have where we have to forecast the levels of the market. This is only for public market managers. And so what this means is, if the market rose more than we were forecasting when we signed the contract, you run out of cap, and we had managers that were working for free for the end part of their contract. That was a pretty good deal for us for a while, but it wasn't a fair deal. It wasn't. We should pay a percentage of assets, what the contracted amount is. So on July 1st of this year, we did away with the fee cap. It's gone. And so we're back to paying on a percentage of assets like everywhere else. I thought you'd be happy about that. It was a shameful call for applause, but nevertheless. Okay, so speaking of fees, we care a lot about the fees that we pay you and the competitiveness of the fees that we pay you. And we've made a big deal about that. We made a big deal in the press about it. We made a big deal about it when we talk to you, when we negotiate with you. And I want to talk just briefly about what our perspective is on it, so you can understand what we're thinking when we bring you through this standardized due diligence process. And I talked about this a little bit last year, and you may remember these funny blue boxes. They come to us from a consultancy, CEM Benchmarking. These are the fees in basis points. You can't see the axis, that's on purpose. But you can see at the top of the blue box, if you were right here, you'd be in the highest quartile. You'd be in the highest 25%, bottom of the blue box in the lowest quartile, and along the black line up to the top percentile and down to the bottom percentile. So the different lengths tell you the different distributions that they have. These are passive funds, U.S. equity passive, very cheap. Everybody gets about the same price. The blue is last year. Actually, it's 2 years ago, 2013, and the red is 2014. That's Scott Stringer's first year. We brought the fees from extremely low to extremely, extremely low, which is good. In international passive, fair to Midland, they went up a little higher. We looked into it. It's because we have some specialty mandates. Rather than standard EFA mandates, we have a few sort of one-off mandates. We're going to try to consolidate those and bring things down a little bit. And I don't need to talk much about fixed income fees because they're pretty good. On the active side, our fees are kind of fair to Midland. They're right in the middle in U.S. equities, in U.S. fixed income, right in the middle of the distribution, about 50th percentile. And we brought these down over Scott's first year as well with a lot of negotiation. We have a few very large managers in the international space, and we're able to improve our rates. Here's what I think about paying rates in active investing. If we structure it properly, this is going to be shocking to you. I actually want you to be up here. I actually want to pay really, really high rates. But I'm only willing to do that if you get the performance to stand behind it. So what we'd like to do, and we're beginning to renegotiate in all our public mandates, a performance fee, where the base fee is going to have you down here, and then you can earn a performance fee. We like to keep about 75% of the value added for the 715,000 people in New York City. And you would get 25%. And we hope that that 25%, due to your outperformance, takes you all the way up to the top of the distribution. So even though we're always, hard on fees, I'm here to say today, with that structure, I'd like to be paying some of the highest fees in the industry, but only with that structure. Okay, speaking of structure, let's go to the private asset classes. Now, I showed you this last year. This is the fee drag, north and south, the gross IRR, or gross return, east and west, and the higher the return, the higher the fee. This includes base fees, carry, everything else. The highest line is hedge funds in dark blue, next highest is light blue, PE, and then the other private asset classes are along the bottom. From this, it looks like we pay the most for hedge funds. And hedge funds are much maligned because their fees are so high. It's not always what it looks like. So let's take a quick example. Let's assume, and these are assumptions now. We've gone from reality to assumptions just to prove a point. Let's assume that you've got a private equity fund, 125 basis points, 20% performance fee, real estate 150 and 20, hedge funds 2 and 20. Who's got the best terms? It would seem from this that the hedge funds have the worst terms and the PE firm has the best terms. But you're missing a key ingredient. If you're going to look at excess return, as we do in the public markets, you have to know what could we have gotten if we just invested passively in the markets with the same level of risk. And so let's assume 7% in stocks, 3% in bonds, and the structure of your hedge fund portfolio is 130 long and 100 short. So you have a 30% exposure to the equity markets in your hedge fund portfolio. That would mean that the public market equivalent would be 7% for pure equity. Real estate, which is about half equity and half fixed income, is 5%. And then the hedge funds, 30% of that is 2.1. So the excess returns are quite different and higher for hedge funds. If you take out all the fees and figure out what percentage of the excess return is retained by our 715,000, you get the results on the bottom. And that is the bottom line for us. What percent of the excess return do we retain with the structure we have in place? Now, I'm not here to negotiate today, but I can tell you that the two structures on the left are no good because we're retaining less than half. And since we put up the money, since we take the risk on the downside, less than half seems not good. And most private market structures result in most combinations with us keeping less than half. And that does not satisfy us. And that's the lens we're looking at when we come to do due diligence. So I hope you'll find us, and I'm going to have the group come up here so you can get to know them a little better. Hope you find us to have an investment firm with a long-term focus, We aim to have counter-cyclical cash flows. If we get to know you really well, we want to have you have a sort of constant weight in our portfolio. When you're doing extraordinarily well on a positive slope, we're going to be taking money away from you. And when the wind is really in your face, if we're convinced that you're still practicing the time-honored practices that you have, and we still believe in your process, and we have to know you really well to do that, we're going to give you money when you're down. That helps your franchise, it helps our returns, and I'm going to introduce you now to the teams that are going to execute this for you. And we'll start with Mike Haddad and the public team to come up and take you through a rundown. Before Mike, do you want me to take Q&A, or should we just go right into? I'm sorry. Roll that back. I forgot about the Q&A session. Any questions? Yes, ma'am. Is there a mic for her? Yeah. Mary Beth, if you don't mind. They couldn't hear me, and they definitely won't be able to hear you. And we have people in the other room.
Hi again, this is Mary Beth Holland with Sutton Place Capital. You gave us such a good overview. Knowing that the 7% return is a real challenge. I mean, how much of the pressure is coming down the pike in the next few years?
Yeah. So the question, hey, guys in the back, I don't mind if you want to step out and talk, but if you could wait till you get outside, that'd be great. So the question is for Mary Beth is, she sees that we have a 7% expected rate of return. Do I see that as an obstacle in the next couple of years? Yes. And we've talked a lot with the boards about the fact that while our expectation remains 7%, and that's the actuary's expectation and the state law's expectation, you have to look very, very long term, like 30 years, to believe that it's possible to get a 7% return. We're going to go through almost certainly a period over the next 3 or 4 years, and unless we see some radical changes in fiscal spending and inflationary expectations, we're going to see subpar levels of return because of the extraordinarily low inflation rates and commensurate interest rates. So I would expect some subpar years ahead. But this is a long-term game. And in the rearview mirror, we had the global financial crisis, and still over a 10-year period, we're able to sustain 7. I think the next 10 is going to be tough for 7, but the next 30, it's still a possibility. Other questions? Yes, ma'am. If you can get to a mic, or Mike can get to you. We
Hi,
have some
Scott.
mics down in front, so if you have a question, come on, step down. Yes?
Belinda Cavazos with Boston Trust and Investment Management. To the extent that you're willing to shift to performance fees, over what period are you going to calculate it to ensure that your managers have a long-term approach?
Yeah, it's a great question. It's a matter of, so how long a period would we look for management fees? Certainly no less than a 3-year time period. And it's a matter of negotiation, and we like to look at a fairly long-term time period. It depends on the asset class. It depends on the style a little bit of your investing. But we want to see a full cycle for both of us. And we have various clawback rules and that sort of thing. But the intention here is this is a partnership. That we get it. I mean, we're investment professionals ourselves. We worked on your side of the table. We know you have to motivate people, and part of that motivation is for them to be able to share some of the benefits that they create for clients. We just want it to be fair, right? We didn't think our fee structure was fair with this crazy cap, so we got rid of it, even though that's probably a net negative for us. We're wanting to look at things in terms of the percentage of excess returns, regardless of the asset class, and every engagement that we have is an opportunity to talk with you about our partnership and how we can develop something that works for both of us. But certainly not less than 3 years. Yes, sir.
Robert Turconnell from Bruin Asset Management. I'm singularly impressed with both the processes of New York State and New York City. And at the risk of sounding naive, do you ever impart your expertise to other pension retirement systems around the country to help other states and municipalities do better?
Yeah. So the question is, do we talk to other states and municipalities that, you know, he knows New York State Common. Vicki Fuller is my counterpart there. I can assure you, Vicki and I talk all the time about things, and we talk with Teddy Iliopoulos at CalPERS, with Chris Ailman at CalSTRS. We talk with the Dutch and I forget the guy's name, but in Japan, the guy that runs the overall 1.3 trillion system there, and we have a number of networking opportunities to see each other several times a year, and we share best practices. And I have to tell you that as proud as we are of New York City, we have more to learn from them than they have to learn from us at this point. We're working hard to get to the point where it's an even trade, and then before we're done, we'd like to be sharing best practices with others. But we're on the steep slope at New York City at the moment. Yes, sir.
David Kramer, Hudson Companies. I'm curious how the 70% funding compares to the other, say, top 5 pension funds in the country, and how much additional funding does New York City provide?
Yeah. So the question is, our funding ratio of 70%, how does that compare to the other systems? And how much funding does New York City provide? You know, the contributions every year, I think, are $10–11 billion, and that's it's like 15% of the budget. It's a huge amount, but a lot of that is catch up. We have one of the more, believe it or not, one of the more conservative discount rates at 7% assumed rate of return. Others have higher ones. CalPERS is trying to bring theirs down. New York State has brought theirs down. New York State's a little bit better funded than we are. I can't do CalPERS and CalSTRS off the top of my head. My recollection is they're in the same neighborhood as us. I think New York City's 70%, and 70% is probably about typical for large pension funds. Don't hold me to this. The discount rate actually is conservative. We practice fairly conservative actuarial practices, which I was pleased to see, and we make our extra contributions every year. That's huge. They don't do that across the Hudson. They don't do that in other places. They've had a little trouble with that in the middle of the country, and that's what really gets pension funds into deep trouble, making the extra contribution when you fall behind. We all fell behind during the global financial crisis, and it's part of a healthy system. I've been involved. I just stepped off the board of ABP in the Netherlands, where they're under a different system. I've been with them for 8 years. They're fully funded at a 2.5% discount rate, and they're nervous as hell that you know, they're not going to have enough money to retire. So very different system, very different focus on the pension promise. And we had a lot to learn from them, which is one of the reasons that I was involved with that, both with my previous job and with this one. Yes, sir. Here she's going here.
Thank you, first of all, for that quite insightful presentation. Chad Elson, I'm the Chief Operating Officer of a long-short equity hedge fund, South Street Capital Management. I was intrigued with your questions about execution and prime brokers. One of the challenges, I think, for hedge fund land is that our prime brokers provide not just best execution, but extraordinary amounts of analytics, as well as cap raising.
Right.
But there's just a lot of information that you get from a larger institution, as well as where they clear through. Obviously, your clients are interested in knowing that. Is there some way that we can work with you all to find ways to employ smaller broker-dealers, let's say, who can't provide economically the analytics and all of the reports that a larger institution can?
Bless you for that question. Where's Mark Pendarvis? Mark, he was in the house. He must be out in the back room. I'm going to introduce you to Mark Pendarvis after the show. He is the guy at the point for us on Minority Brokers, and he'd be happy to talk to you. I think it's a great offer, and we appreciate that. He is in the house somewhere. I'm getting the hook. I got time for one more question?
Thank you very much. Mark DeSalvo from Semaphore in Boston and in New York, of course. Two questions. Where do you think will be the most severe changes in allocations that you'll be doing over the next 3 to 5 years? And then lastly, do you see any proximate either socioeconomic or macroeconomic factors, including political factors, that are going to influence what happens to people in this room over that same period of time?
Yeah, I think the major challenges for allocation are staying diversified and being in asset classes that promise north of 7% when you're realistic about it, and that's tough. The other thing is the fixed income area is deeply challenged with rates at unbelievably low levels, spreads at record tights. Very, very difficult in fixed income. We've spoken a lot with our trustees about this as we contemplate allocations. Some of those discussions are on our website, and I see it evolving. You will not have sort of static 60-40 and sleep on it environments over the next 10 years. It's one of the reasons that I imported a great macro thinker in Mike Haddad, who'd been managing rates for George Soros and Bruce Caxton, because we needed that type of tactical mind here. We're not going to become day traders. We're not going to be trying to take a $160 billion fund and run it like a hedge fund speedboat. These are ocean liners. But we can't be ignorant of the environment that we're in and the fact that these are very, very rough seas. So I'm happy to have Mike here. And since they're giving me the hook, I'm now going to bring Mike up here with his team to give you a little flavor of what we do on the public side. Mike Haddad.
If I could ask the 5 general consultants that we've asked to participate in the panel, come on up and grab a seat, please. And while they're coming up, I'll just spend a few minutes talking about the next 3 fireside chats or panels that we're going to offer up to the participants here. The first one is with, the first 2 are being moderated by myself. The third one is being moderated by my cohort, Alex Danier, and will be on private markets. My first one is with the general consultants, and we're going to, the second one is going to be with 3 of the asset class heads on public markets. And the broad context of the objective of these panels is twofold. And one is to share with is that better? I think there's some feedback. And share with the group the process by which investment managers start doing business with BAM and retain that business. And the second part is going to be more about the investment philosophy and the guidelines and parameters about how we build the portfolios for each asset class. So with that in mind, I'm going to ask each of the panelists to my left to introduce themselves, the firms they work for, and the roles within their firm.
Good morning, Bud Palecchia with Callan Associates. I'm a general consultant for the firm located in New Jersey, and I work with the New York City Employees Retirement System.
Hi, good morning. Lisa Florentine. I'm a partner at Rokaton Investment Advisors. I head up the public fixed income group, which I guess was referred to as the challenged area of the market.
Good morning, my name is Ben Hall. I'm from Siegel Rogers Casey, and I'm a director on the equity research team in New York office.
Good morning, Ramon Gonzalez with Wilshire Associates, based out of Santa Monica. I'm a vice president and oversee our manager research effort dedicated to global equity.
Doug Mosley from NEPC. I'm a partner. work with public funds and also serve on our manager due diligence committee, and we work with the fire pension.
So just a little bit more on process. I know we're running a little bit late, but I think this is a key part of the program today. We're going to try and stick to about 30 minutes each of the panels, and roughly the first half or 20 minutes with me quizzing these guys, and then saving some time for questions and answers at the end, please. So why don't I start off the first question. If each of you could describe the criteria for evaluating managers and the process by which you put together a search for the BAM investment staff for managers. And if I could ask you to speak with a lens of both if it's specific to a search or if it's in your general due diligence that you guys do in your day jobs. So we'll snake back and forth, Doug, so we won't meet with you last every time.
Start. Okay, so a couple of things that might be a little bit different at Callan Associates is one, we use our own proprietary database. So all managers need to have their information, especially with regard to the public markets, in the Callan database in order to be considered for mandates with any of our clients. Secondly is that we do not have a buy list of managers that we typically recommend to all of our clients. We start each search from scratch based on either the search criteria that is driven from the client themselves or from a profile that we generate in conjunction with the client. As far as the due diligence process, we have specialists in each area of asset management. So we have specialists in public equity, public fixed income, as well as the alternative asset classes. Most of those research specialists are located in our home office in San Francisco, but we have also others in other areas of the country. Fixed income specialists, the lead, Brett Cornwell, is in Atlanta. As far as the search process goes, again, we start from scratch. We call our database, which is the beginning part of how we get to know managers. And there are screens that we go through that focus on quantitative rolling 3-year performance. We want to look at consistency of performance for each one of the managers, risk-adjusted performance. And then there will be obviously a number of qualitative screens that is based off of how well the research analysts know each firm, as well as the general consultants like myself. And then the search process continues in that there is a peer review process, and we have a committee called the Manager Search Committee. So before we recommend any of the managers to any of our clients, there is the approval of the Manager Search Committee, which is made up of senior consultants from around the country that meet on a weekly basis. So I guess I would encourage you all to get to, first and foremost, to be in our database. Then to try, I know it's a difficult job sometimes to get in front of professionals at each one of the consulting firms, but if you can get in front of our research specialists, and then to the extent that you can get in front of the general consultants like myself, those that work with specific clients, and then those that are also on the Manager Search Committee.
Hi. Okay. Is this better? Okay, I'll try to speak up. So perhaps I'll point out maybe some differences in our process, and just I think probably we all follow similar processes. At Rokutan, for sourcing, we use kind of our network, which is all of you in this room, as well as the investment database, which is a public database. It's free for managers to put their information in, and that's kind of where we start with sourcing. We also look at a number of qualitative and quantitative factors when we're recommending managers to our clients. We have a research team that's responsible for all manager recommendations and ratings to our clients. And we specialize by asset class. So as I mentioned, I head up fixed income, and I have a counterpart in equity, and we have counterparts, and I have a counterpart in alternatives and in private markets. Maybe just a few things to note about how we work with New York City when conducting a search that may be different from how we work with other clients. So when we work with New York City, we do start with sourcing, and managers are, asked to update their information in eVestment, and it's very important that they do this by a certain time period and that they do it with completeness, because we'll be screening that universe on minimum standards, whether it's assets under management, strategy assets, track record. But if the information isn't there, you simply, you could be eliminated from the search, just for simple reasons. So we do work with the city in terms of establishing those criteria. And then from there, when we have a long list, we use these quantitative and qualitative factors to come to a shorter list. Not every manager that we'll recommend necessarily is on the Rokutan buy list, but it still is vetted under the same type of criteria that we're looking at across the investment manager universe. Like Callan, we also have a process when we do rate managers that we have to have approval for that rating through a research review process, and that includes all research team members and several consultants at our organization. See if there's, I think later in the conversation we'll get into maybe how some of the criteria that we look at differ for developed and emerging managers, but I'll save that for later.
But before you pass the mic, Lisa, quick question, and Bud, you can chime in as well, and the others. I think the quantitative measures we're all kind of familiar with, and it's rate of return,
Sure.
It's risk, it's drawdown, correlation. The qualitative ones are less obvious. Can you share a little bit of the qualitative criteria that are important to Rokutan?
Sure. So let's see. So qualitative criteria would be, so I guess maybe we think of things at the firm level and at the strategy level. So at the firm level, business leadership, that's important to us because we want to make sure that, that they're providing the resources, the infrastructure to ensure success for the investment teams. Compensation structure, we're always trying to see if there's an alignment of interest between the investment professionals, and the organization. So, we focus a lot on how they're compensated, how it's aligned, is it in line with the client's success. Let's see, we also at the strategy level, it's qualitative and quantitative, but we're looking for a differentiator. How do they approach the market that might be different? Where is their expertise? And that's not always easy to tease out through quantitative measures.
Hi. So at Siegel Rogers Casey, similarly, we utilize a network of our contacts in the industry, as well as building on the data that is provided within the eVestment Alliance database. I would just emphasize again the importance of full completion of that database with quality data, because inconsistent data across several managers can lead to you being easily omitted from searches for simple reasons. And then upon idea sourcing, we then move to a very qualitative approach where we assess all managers through the lens of our 7 principles. So our 7 principles being divided between organization, strategy, investment process, team, operations, performance, and finally terms. And now the bulk of the work that we're doing in the investment research process is focusing on the team, the process, and the strategy. We're really looking for a differentiated approach which is intuitively logical and has the ability to generate significant alpha for our clients. And really, once we have comfort through communicating with the managers and getting to know them over an extended period of time, we're then comfortable to move towards looking at performance data, and again looking at consistency of performance over rolling 3 and 5 year periods, upside and downside capture within the market to understand how a strategy is going to perform through different parts of the market cycle. And in terms of constructing this together into a research report, which would be ratified by presentation in front of all of the senior directors within the firm. And then that becomes part of our buy list of managers, which covers all of the style boxes within the domestic and international universes. And within the equity side of the business, we have approximately 400 strategies that are on that recommended buy list, with a strong bench of ideas that are under consideration, and around 200 fixed income managers with a similarly strong bench ready for managers that are ready to be stepped up in the event that a manager does have a significant change in its business and was to be no longer recommended.
In terms of Wilshire, we have, I would say, similar to Callan, we're split by sector teams. So everything from hedge funds, liquid alternatives, we go into the public market space, U.S., non-U.S. equity, fixed income. But the genesis of every search is pretty much standard. We start with the client criteria, working in concert with the consultant to determine what do they need in terms of a basic operating paradigm. So a lot of it's quantitatively driven. We use our proprietary database exclusively called the Compass database. All managers are welcome to and encouraged to really populate these databases with their strategy, information, quantitative data. It's free. That is the primary source of our idea generation, but we come to conferences, we meet with clients, we meet with emerging managers to really extend that network. From there, we do look at quantitative criteria. We'll make sure that we can, for the most part, fulfill what the client's looking for, but it's really, despite us having a fairly standard approach, we really take a qualitative approach to our process. So we do have a conviction list. We call it our focus list. It's not the all end all be all. Most of these strategies, we rate our system is basically first decile being best, 10 worst, focusing on the upper echelon, 1, 2s, and 3s. That focus list is really comprised of 1s and 2s. But through that process, we encourage managers that we actually rate, let's just say they're a third manager, third decile. It's not exclusively 1s and 2s, but because what we're emphasizing here is manager alpha diversification. So we'll have managers that will come to us and say, hey, there was this public pension plan that we were a part of in terms of a search, but we noticed that you guys went with another shop that really isn't a 1 or a 2 from what we've heard in the industry. And it's really the merit there is because of the manager alpha diversification proposition. So again, being part of our conviction list is not an exclusive, target to get into our searches. We really, welcome everybody to participate in the search, assuming that they fit the criteria. To answer the question in terms of what we look for, this is a tough business for us. I've been doing this for 16 years, and the numbers are the numbers. One year you'll have managers that underperform by 8%, sometimes they'll outperform, and overall it's really working to understand a process. When we work with managers, we want to make sure managers can articulate what is the key advantage, right? Is it the culture, is it the people, is it the process, the unique aspects and attributes that really differentiate you from the rest of the pack. We meet with so many managers, hundreds, that after the nth meeting, it all sounds the same to us. Everybody has a great team, everybody has the credentials, everybody's been doing this and they do it well. So where there are key advantages, I just encourage managers to really present well and help us understand what is the performance trajectory here so we can have unintended surprises when we meet with our clients, hire a manager, and then later down the road, we end up seeing that these performance track records don't reconcile with the stated philosophy. So again, for us, we emphasize a lot on the qualitative. We're known to have, we were founded as an analytical shop, technology-driven with that strong infrastructure, but it's just another compass. For us, we really spend a lot of time with teams, firms, discerning what is the genesis of an organization. Why did you establish yourselves in the first place? Some firms are, more sales-oriented, so it's just gathering assets. But we really want to spend time with executive leadership. We want to spend time with compliance, the operational infrastructure. We're seeing increasingly a very costly regulatory environment. So we spend a lot of time determining, especially for quantitative strategies, hedge funds, where you do see the threats of cyberspace. So a lot of these things, we spend a lot of time at the front end with the firm, and then we spend a lot of time with each team to understand, what are the motivations here for these team members to remain with the firm, exhibit low turnover, exhibit consistency, and strong succession planning across the board. So that for us is very key, and we spend a lot of time. We really appreciate that time that we spend with management and having access to the right professionals to help us ensure that our clients, in this case New York Police, do have a good understanding of what they're investing in.
So Ramon, a quick question. You mentioned important correlation with managers within an existing portfolio. So, for example, if you're conducting a search for us in, let's just say, IFA Equity Manager, you could end up with a very different recommended list to us than to, say, some other pension fund based upon current managers.
Right, absolutely. So that list will be different. LA City, for example, and LA County, they're big on emerging managers. So, in some cases we'll have, there'll be some exceptions. We'll introduce a manager with a fourth decile because there's huge business risk associated with these firms. Is that operation, that enterprise going to be viable over the longer term? So, that'll be a smaller allocation. We had an international small cap manager with less than, I believe, 350 million at the time. And so we made an exception there and including them in the search, knowing that over the long term we thought that there was a high degree of confidence that they would remain viable in the industry. And ultimately, they ended up having a small allocation, but nonetheless, 30 million out of a $10 billion plus pension plan. It's not necessarily meaningful, but it was important to that client.
Great. And just briefly, in the interest of time, I would say our process is similar on the manager research side in terms of the structure. We have dedicated specialists covering the different sectors of the fixed income and the style boxes on the equity side. We have a manager due diligence committee that essentially peer reviews the work that our research team is doing and brings that client perspective to bear in terms of approving the managers we recommend. Our rating system is a little bit different in that we have a smaller group of managers that we recommend in each category, say 8 to 12 managers. And then we have other products rated essentially neutral or not recommended. And then we have kind of a due diligence status recommendations for managers or products that are going through an issue that would lead us to, to put a hold or a watch or a do not use kind of rating on them. In terms of the search process, though, I think, similar to my colleagues here, we start with the client. And so we have that rating system, but for public pension funds, I think we start with the client with a process of discussing, the minimum criteria that they want to use, and we apply those criteria, and we really do look at the firms that screen through that broadly, and not just going to go right to the firms that we've already are recommending. So in a typical public fund search, if we're going to profile 8 or 12 manager products in a search book or presentation to staff or to a board or committee, generally there's going to be a mix of firms that are neutrally rated and firms that are rated recommended. And I think in the most recent case for New York City, it was kind of a mix of about half and half. And so I think that it's very important in the public marketplace that process be open and be considerate of all strategies that are competitive, and then go through the traditional due diligence process that we would go through with any strategy as part of the process.
Very good, thanks. So Doug, you get to start with the next question, which Lisa anticipated. How does this process differ for a small manager, small by AUM, a newer manager, or an MWBE?
Well, so I would say that I have a couple of big clients, including New York City and one of the state of Illinois plans. And so they're very focused on the best way to get access to emerging managers. And in the case of the Illinois plan I work with, over 20% of the capital that they have deployed is with emerging managers. And so the process is somewhat different in that you probably have a heightened level of what I call business risk with smaller firms. So you need to assess that. And you do need to nurture those managers and those organizations a little bit more closely. And some of our clients rely on the emerging manager programs to do that and to incubate and kind of develop those relationships. And then, as Scott alluded to, is to graduate those managers through a process. and others are more willing to put smaller amounts of capital with those managers, work with them on improving their business practices and obviously monitoring their execution and their strategy over a period of 2, 3, 4 years, and then slowly ramp up the size of those accounts to the point where they're competitive with other majority-owned firm mandates in their portfolio. And I find that generally, if a firm's investment process is very solid and they deliver returns that are pretty consistent over a 3 to 5 year period, they typically can accumulate assets and fill in some of the gaps in their business due to the higher increase in revenue. And so I think it's a little bit more hands-on, I guess would be the simple way to describe it.
Thanks.
Yeah, I'll just add, for us, it's pretty similar. We don't have in our database a split out for emerging managers. So what we do is really more labor intensive. We're going to work with the client really closely. They'll have legacy relationships. We'll have likely legacy relationships. So it's really just a strong network. It's going to take a little bit longer. But nonetheless, the standard protocol is to still populate our databases. We'll work really closely with the client to determine what is that list of managers that they want to go through. We'll bless it in terms of doing our own due diligence. But we still, I would say, each manager is still going to be subjected to our research process in terms of our due diligence practices. But we'll spend a lot more time in terms of assessing the firm's infrastructure. Sometimes you'll have really talented professionals. Trading operations will be, substandard. There'll be a lot of things that are not of institutional quality. So we'll communicate with the client in terms of assessing. This is a prescription. We're gonna go with this manager, but we need to understand that there's a lot of risk associated with their infrastructural platform. The technology is not on par, but nonetheless, there's maybe some leeway. But again, that's in accordance with client expectations and their tolerance to really delve into a manager that exhibits, on the margin, more risk than a more established enterprise.
Just in terms of specifically identifying minority and women-owned managers, we do a periodic quantitative screens within eVestment to try and identify those firms with ownership of more than 50% minority women-owned. And then in terms of the process that we're using for researching these managers, I would say we're still using a consistent approach of the 7 elements or principles that we utilize for more developed managers, but that the underlying elements beneath those principles will be adjusted slightly. The fact that it isn't a quantitatively driven process means that there is the experience of the research professionals that are engaging in this research to assess emerging managers on a slightly different basis. While obviously we are concerned about the ongoing financial strength of a firm, we are conscious of the fact that there is certainly an excess alpha potential for smaller and emerging managers, and we're keen to capture that as much as possible by being decisive and rating managers at an early stage in their genesis.
So I guess I would concur with a lot that I've heard from my peers here in terms of kind of the focus when we're evaluating emerging managers. Having to spend a lot of time on the business, the compliance aspect, because those certainly, I think there's more risk in those particular areas. So when we're doing an emerging manager search, certainly if we have minimum standards that we're working with the clients on, those have to be relaxed to some extent. I think maybe the other point I'd make is for plans that are looking to build out emerging manager programs, I think there's certain areas of the market that maybe lend themselves better to those. So if I think of fixed income, it's very costly to have a multi-sector fixed income strategy, and very difficult to be competitive. So I think we would, look to other areas of the fixed income market, more capacity constrained, areas that, it's easier to differentiate. So, I think maybe that's just something different that I can offer.
Just quickly, Mike, one of the general things that we like to do with our clients when we're setting up the minimum qualifications is to encourage, lowering maybe some of the minimum dollars under assets under management so we can include some of these emerging firms. Also, I would like to point out that Callan does have an outreach program called Callan Connects, where we recognize that a lot of the emerging firms don't have the budget to get out to San Francisco. So on a quarterly basis, we come to different cities, and we encourage you to sign up for those meetings. They're usually over 2 days, and we try to get to know the emerging community a little bit better than we currently do.
So let me turn it over to questions for anyone up here. Yes, sir.
Yeah, is it, pensions are unique across allocators for their dependence or use of consultants, and pensions have really been unique over the last 10 years for their performance through the recovery. And I'm curious to what extent you think consultants have contributed to that performance and the underfunding, and what changes have consultants made specifically to the relationship between pensions and consultants to improve or address the issues of performance?
I'll take a step. I don't know if I understand exactly where you're going with the performance. Are you indicating that you believe pensions have underperformed?
Like the performance through the recovery.
Empirically compared to?
Other managers or other portfolios, the markets.
Okay.
Yeah, that's what I'm talking about.
And so your conclusion is that public pension funds have underperformed?
There was a question, to what extent do you think consultants contribute?
So I think that consultants contribute as serving as in a couple capacities. One as an extension of the staff and the board of trustees, who, depending on the plan, may not have a dedicated investment staff. Some of them do. And so bringing additional insight into different markets and asset allocation, and bringing asset allocation tools to the decision making, all of that is part of the process. I guess in terms of the funded status changes that have taken place, I think part of that has been driven by market performance through the financial crisis, but also the drop in interest rates and the other actuarial assumption changes that have taken place. So there's it's a very complex and nuanced issue. But I think generally the consultants serve as advisors, gatekeepers, and contribute to that decision-making process.
Yeah, and let me just add a little bit. Scott had alluded that we use every consultant on the planet but one. Facetiously, we use the consultants. We consider them partners as well. They're trusted advisors to us. They're trusted advisors to our trustees, and they add a tremendous amount of value to us. They add value to us. They add value. The 5 up here represent the general consultants, and we use them more on public markets. We have a different set of consultants that we use on private markets. In addition to what they didn't delve into, which was later in my queue, was their parts in asset allocation, their part on terminating managers, changing AUM within different managers. So they're very interactive partners with us in this process. Any other questions? Yes, sir.
You spoke a bit about your due diligence trying to make an investment. I'm just wondering what you do on an ongoing basis so you can spot a red flag and are able to make a decision prior to a drawdown rather than after a drawdown from a manager.
I'll take a stab at it. That's a $1 million question.
And before you jump in, Ramon, the second panel is going to be, you're going to hear from 3 of our heads of asset classes who, it's a big part of their job, but we work together with our consultants on this.
Yeah, that's a tough question. I think we try to do our best. That's the most generic response, but for the most part, it's really client by client, manager by manager. I work a lot in an inefficient markets, especially emerging markets, where the tolerance for tracking error based on what the client wanted initially, let's just say, fundamental, very active. In that case, there'll be a stronger, kind of like a looser leash in terms of their underperformance, should they underperform. But there's not, clients have a watch list. That watch list, to some degree, it's very quantitative, but we do have that qualitative overlay to help govern some of the termination decisions. It's a costly decision both ways. So ultimately, it's really just a matter, it's client by client, case by case. There's no standard formula in terms of For one client, it could be New York Police have a lower tolerance, for example, on an IFA mandate. We can have another client who has a greater tolerance for the underperformance. It'll be the same strategy, same manager, same qualitative opinion that is very favorable, but one of our clients may decide to ultimately terminate. So we work in concert with the client to understand the implications of that termination decision, because ultimately it's going to be costly on the other side when you try to hire a new manager.
And I apologize, we're gonna end the questions here, but as a reminder, we have a network session at the end of this, and each of these individuals will be available for that. So thank you guys so much, really appreciate it.
Three. There should be three. Oh, yeah. Okay. Thank you. No, it's just us. There's one down there.
If I could ask the audience to grab a seat, we're going to try and kick off the next fireside chat right away. Okay, thanks. So this is fireside chat number 2. You're going to hear directly from senior investment staff at BAM. And I'll just take a quick second to introduce the panelists to my left. The bios are all in your packet. Immediate to my left is John Merseburg, who heads up public equities for us.
Hello.
In the middle of the table is Robert Fang, and he heads up public fixed income for us. And to Robert's left is Neil Messing, who is the head of hedge funds for us. So again, the objective of this is to share with you how managers, how you all become managers with New York City, how you retain that status. And the second part of what we're trying to explain to you is the portfolio philosophy and the principles that drive the composition of the portfolio. So John and Robert, let me kick it off with you first. Just gonna try and get that door closed back there. Could you share a little bit with us about your investment philosophy and maybe a little bit about the principles that drive the composition of the portfolio and within sub-asset classes for the public markets?
Sure. I think I'll start off with some of the geography, how we're laid out in public equity. We've got about $84 billion in public equity. Most of that, about $58 billion, is in U.S. equity. Most of it is passive. We're only about 16% active, 84 passive. We've got about $16 billion in other developed markets. Most of that, 87%, is active, the remaining passive. And we've got about $13 billion in emerging markets, and there we're about 62% active and 38 passive. So as you can see, most of the actively managed money is in non-US markets, but all of the $84 billion is externally managed.
Why that split? Why that ratio?
It's really driven by the asset allocation, and we're always going to be a little bit different from the market because of the New York State basket clause. That kind of limits our investments in non-US markets.
But what about the active versus passive? What drives?
We're basically more active in non-US markets because we think there's more opportunity there for active managers. Also because of the size of our assets, we kind of feel passive management is our default because while markets may not be efficient, they're not so inefficient that it's easy for active management to outperform, especially net of fees. We kind of move away from that passive default only if we're convinced that active management can add value, and after a manager search process where we're confident the manager can kind of meet the burden of proof and outperform. Also for active managers, Scott mentioned earlier, we believe we should keep 75% of the excess return since it's our capital at risk. And then even for more quantitative strategies, we think we should even keep a higher percentage of the excess return. And we're more active non-US because we feel those are more inefficient markets. One other thing in terms of fees, you know, given the low anticipated return environment, fees are a significant portion of the excess return. So whether they're high or low can have a significant impact on our ultimate success in funding our liabilities, especially when you compound that over really the indefinite lifespan of the retirement systems. And then just one more thing, where we do use active management, our aim is to build a portfolio of managers that provide us with uncorrelated excess returns. We want them to get there in different ways.
Robert?
So the overall goal of the fixed income program is to obtain risk-adjusted returns via both price appreciation and income while reducing the risk of the overall portfolio. So that is our portfolio philosophy for fixed income. In terms of our composition, we're mostly a U.S.-based composition, where it's about 95% of our overall assets is in active, because there's inefficiencies in the public fixed income markets to gain advantages through that. And I think that's our current composition is we have 7 sub-asset classes. The 7 sub-asset classes are government/long duration treasuries. We also have IG investment grade credit. We have mortgages. We have high yield, bank loans, TIPS, and convertibles.
Yeah, Robert's modest about the goals of the program, but in reality, the fixed income has led the returns.
At times.
Neil, it's different in the hedge fund, the way that you look at your portfolio and your investment philosophy. Can you share a little bit with that, please?
Sure. We take a low beta approach with the hedge fund portfolio. We have so much long only money in equities and fixed income that we just don't need those. We don't need long biased approaches in the hedge fund portfolio. Also, we philosophically believe that the less shorting that you're doing, the more long biased you are, the less you deserve the fees that you're probably charging on the hedge fund side. So, the hedge fund portfolio is the only place in the entire pension portfolio where we have any managed futures exposure or any shorting. We have about half of the portfolio invested in managed futures strategies or discretionary global macro, and then quantitative macro, and we're actually looking for a commodities manager to invest in. And then the other half of the portfolio has an element of beta to it, and those are long-short equity strategies with a low net exposure, and also event-driven strategies with a low net exposure. So.
We heard from the previous panel a lot on how they evaluate managers, and they spoke about a search process and lists that they develop for us when we're active looking for a new manager. So let's start with public markets again, and John and Robert, can you describe the process for how a search originates, what drives that, and then once that search that request goes out, kind of walk the audience through what that means, the use of the consultants, use of your staff, You know, when you narrow the list from whatever we get back to the final 4 or 5, the process that we put these finalists through, you know, all the way to investment committee, and then share again how we you interact in a sim with our trustees.
Sure. Typically in public markets, manager searches are initiated because a change or an update to the asset allocation, the expiration of existing manager contracts, or the need to supplement our manager pool or replace current managers. As described earlier, we use a consultant-driven process to hire managers as per our PPB rules. The 5 general consultants were represented on the previous panel, and I'll reiterate what was said earlier to please get your firm and product information into the eVestment, Callan, and Wilshire databases. That's where the search starts. And then as part of the search process, the appropriate asset class teams from BAM will do additional due diligence on products recommended by 2 or more of the consultants. So for that list, we'll send those managers a due diligence questionnaire. We'll do on-site manager due diligence visits. And you know, when evaluating the managers, we look at pretty much what you'd expect: the organization and firm, the product, the team itself, the philosophy and process, risk management, compliance, and performance relative to the market environment. So then the asset class team that's gone out and done the due diligence will make recommendations to the BAM Investment Committee. The BAM Investment Committee is comprised of the CIO, the head of public markets, the head of private markets, and the asset class heads rotate on that committee. So once we get it through the BAM Investment Committee, we then will make recommendations to the boards of the 5 retirement systems, and the boards make the final decisions in terms of hiring and firing managers.
So just 2 cents on the investment committee. That was newly instituted with Scott Evans, and it was brought up by both the controller and my boss about the SIM meetings. And this is an example. The investment committee is an example of how investment staff's time has been freed up to do more diligence and more monitoring of our managers. So sorry, go ahead, Robert.
So the fixed income process is pretty much the same. I do want to say that the investment committee meetings are extremely important. They help us in terms of finalizing our product to the boards. You know, we get a lot of questions from the members of the committee, and I think we get like 20 or so questions in. So this really helps us kind of fine-tune our presentations, fine-tune our recommendations for the boards.
Neil, your process for managers is different. You don't do a search. Your use with your consultant, Axia, is different. Can you walk the room through your process for selecting managers?
Sure. We really get our ideas from anywhere. I'm sure I'm going to meet lots of new people here today. We'll look at all of your materials. Scott might send me an email, forward me an email from somebody that he met. We attend all the capital introduction events. We talk to our consultant, exchange ideas with our consultants. Somebody was asking earlier, do you talk to the other pensions? We talk to the other pensions. Sometimes it's really easy to see who they're investing in because it's in P&I online. Barron's puts out a list every year. There's lots of industry awards. Those awards are usually based on who generates really, really good performance. So, those lists can be interesting to go through. But we really get our ideas from anywhere. In terms of our process, we follow what I would say on the investment side is a standard hedge fund investment due diligence process. Our consultant does all of our operational due diligence for us. and our consultant does separate investment due diligence separate investment due diligence from ours.
So Neil, continuing with you, how does this process change for a small manager as defined by assets, an emerging manager, or an MWBE?
Our process doesn't really change depending on your size. We don't have a stated minimum in terms of assets under management size. We one of the things I probably should have mentioned earlier about our portfolio philosophy is that we do prefer smaller and medium-sized funds, although we have some investments in some of the larger hedge funds. We don't have a stated minimum, but we've looked at funds probably as small as $50 million, but we probably need you to be around 200 or 250 to really start our investment due diligence process. It depends on the strategy. We do like capacity constrained strategies, and that's why we end up looking at some of the smaller funds. But something that's also important is that we really need assets to be doing this instead of doing this. And so, yeah.
Any words of advice to any investment professionals in the room who might be thinking about starting out on their own? So they don't have the same resources to market. They may not have an investment relations team. They may not have a legal attribution record. Any advice to someone thinking about starting their own firm?
Yeah, I would just say, you have to get out there. Talking to your prime brokers, make sure they know that you're an emerging fund. Talk to any of the relationships that you have. Make sure that they know that you're an emerging fund. Come to events like this. Try to get invited to the emerging manager events, and it's work. So you do have to get out there and let people know that you're starting.
Before we hop to questions, John and Robert, quickly, anything you guys do differently for small, emerging, or MWBEs?
In terms of the consultant-driven process, they're certainly involved in that. They should get in the database. We also engage with MWB and emerging managers through the 4 fund of funds. There are ADDX, Capital Prospects, FIS, and Progress Investment Management. And I believe they all have representatives in attendance here today. So a smaller firm could speak to representatives from those firms as well as speak to us.
Yeah, pretty much the same. We do have fund-to-fund managers, and we do actually do some of our assets are direct with our managers as well. So we're always looking for, whatever, there are good managers out there, but fixed income is a scale business. That kind of makes it harder, but, we're definitely open to it. And if we see good ideas, we definitely will, try to move on those.
Let's turn it over to any questions from the audience. You guys are so thorough. You wowed them all. Great, thank you. Next up will be, again, my counterpart, Alex Donier, with Private Markets.
There's one here.
And if we can also have the private market consultants come to the front row, please. And we ask that you take your seats so we can quickly move into the private markets portion of the discussion. You know what? You can sit. Well, good morning. Let's get started with the private markets discussion. First of all, thanks again for attending our conference. We're very excited to see all of you here today. A special thanks from the private markets team to our trustees for all of your support throughout this years and throughout the years to helping us make BAM a better place. And also to the UFT for hosting us once again. In this panel, I'd like to introduce our asset class heads in private markets. We have to my immediate left, Yvonne Nelson, head of real estate, Petya Nikolova, head of infrastructure, and Wesley Palusik, head of opportunistic fixed income, or alternative credit. Together with the four of us, and I also serve as the head of private equity, we are managing about $25 or so billion of the pension plan's assets. We also have with us in the front row the consultants that we work with very closely in each of our portfolios. We have Townsend and Cortland, who advise the New York City pension plans on real estate. We have Rokutan and Callan, who are part of the team advising us in opportunistic fixed income. We have Hamilton Lane that advises New York City in private equity. And we have Stepstone that advises New York City in private equity and infrastructure. Let me start with a little just overview of each of our portfolios. Let me start with private equity. The PE portfolio today is about $10.5 billion. We have about $18 billion exposure to the asset class, including unfunded. We do invest in most sub-strategies of private equity, so buyouts, of course, growth equity, special situations and turnarounds, and secondaries. However, we currently do not invest in venture strategies. The portfolio is geographically diversified, and we have a focus on North America and Western Europe. And as many of you know, we have a very strong and proud emerging manager program. We began investing with emerging managers in 2000. We launched our direct emerging manager program in 2012 with a $425 million allocation, which has been fully committed. And that is dedicated to funds 1, 2, and 3, so really smaller managers and helping those managers launch their businesses. We re-upped that allocation last year with the help of our boards and our trustees, and the re-up was a $500 million allocation. Once again, those dollars dedicated to our smaller managers, funds 1, 2, and 3. And as Scott Evans alluded to in his earlier presentation, we've expanded our emerging manager program with a graduation program so that we can retain our best-in-class emerging managers as they grow, and they grow from their fund 3s and beyond, and from $1 billion to being multi-billion-dollar funds. So we're excited to continue our relationship with our best-in-class managers. Let me turn it to Yvonne to give us a bit of an overview of the real estate portfolio.
Sure. Good morning. Can everyone hear me? Because I know I speak kind of low sometimes. Thank you very much for coming. And just to kind of give you an overview of the real estate portfolio, it is broadly diversified, and let me tell you how we do that. We have about $7 billion in market value right now. Our exposure to the asset class is about $10.5 billion, so we have quite a bit unfunded and some dry powder to invest, hopefully, in the next correction. We have strategies. We have the core strategy, which objective is to, as an inflation hedge. And then we also have our opportunistic non-core component of our portfolio that objective is to provide growth to the overall portfolio. As Scott indicated before, that portfolio is we're kind of roughly is kind of half core and half non-core at this particular point. The portfolio, we have about 70 investments at this particular time, and we have 45 managers working hard for us. Now that number seems like a lot, but if I look at the top 20 relationships, about 85% of our portfolio is covered by that top 20 managers. And the other we consider legacy. And we continue to add new relationships, best-in-class relationships. Our view in terms of best-in-class, and I'm sure that this probably has resonated throughout today, is that best-in-class to New York City doesn't necessarily mean big. Some of the managers in our portfolio are middle market, some of them are smaller. In fact, one of the managers that's been driving returns for our portfolio for the past 3 years is a manager that just recently crossed over the $1 billion mark in terms of fund size. So our portfolio is diversified in terms of geography. Like private equity, it is domestically based primarily. We have about 85% of our holdings U.S., about 15% non-U.S. The non-U.S., 10% of that is Western Europe, very much like our private equity counterpart. And as I mentioned before, in terms of property type, we are well diversified. However, we probably do need a little bit more industrial and a bit of West Coast because we're always investing in New York. So would like to reach out and talk to you more. We have a session coming up afterwards, and I'll turn it over to Petya to give you an overview of infra.
Thank you, Yvonne, and good morning. Infrastructure is the newest asset class in the New York City portfolio. We started investing a little bit over 3.5 years ago, and actually only recently did we receive a separate allocation to infrastructure. So now we have an allocation of 2%. What have we been doing over these last 3.5 years? We have focused on best-in-class managers, as Yvonne mentioned, a similar strategy. And for us, this means very few managers writing bigger checks to fewer managers. We focus on strategies that don't overlap so that we really can pick the best managers in the universe. The strategy is global. We actually have more non-US exposure than what you just heard from P and real estate. We are around 40% out of the US. And the reason is that that's the nature of infrastructure. We see a lot of deals coming from Europe, and we also started seeing more movement in the emerging markets where you still can see core assets just in different environment in these countries. So in terms of strategies, we also view the world in terms of core and non-core, and although we don't have strict definitions for these strategies, the core strategies we view as the ones that have less risk. They have, the assets have more yielding properties, and as you go up the spectrum, the risk spectrum, then you become more non-core, you have shorter contracts, and you have some more growth. With that, I'll turn it to Wesley.
Good morning, still. My name is Wesley Pulisic. I advise New York City trustees on their opportunistic fixed income portfolio, what we call OFI. 4 systems participate in OFI. That's NYSERS, teachers, fire, and police. BRRS does not participate. The allocation itself can be described as a long biased alternative credit exposure. Basically, it's all the risky stuff that we can't do on the public fixed income side. You saw the numbers earlier, but I'll repeat them. We have about $4 billion in the ground and an additional $1.7 billion of unfunded commitments. We currently have 13 managers. It's a bit of a concentrated program, and about 2/3 of the commitments are in separate accounts, and the remaining are in commingled funds. We have a few strategies represented in the portfolio. About 50% is in what we call stressed and distressed, another 13% in direct lending, 16% in special situations, which is a catch-all for more thematic strategies. We have about 5% in structured products and another 5% in commercial and residential real estate debt. Unlike private equity, real estate, infrastructure, and hedge funds, we don't have a specialty consultant. We work with the 4 generalist consultants. So you have the pleasure of being diligenced by us and by 4 of them. They're sitting here, and their contact information is in the pamphlet. Sorry. So it's definitely a thorough process. We try to make it as efficient as possible. But ultimately, I think it results in better investment decisions.
Thank you, Wesley. And I thought we'd now give you a little bit of an insight as to how we're thinking about the world, the things that we're excited about, the things that we're cautious about, and how it's influencing and impacting the current capital deployment decisions we're making. And as I think about the world and we think about the world, certainly what we see is asset prices at record levels. You have prolonged low interest rate environment, negative in some areas. We have energy markets that have taken us for quite the ride. The equity and debt capital markets, not too far behind and giving us a little bit of volatility. We can't forget our friends across the pond and Brexit. And we have, struggling with global economic growth and strains to global economic growth. So the question for you, Yvonne, let me start with you on this one. With that as a backdrop, how do you invest in these markets?
Carefully. Let's kind of take a look at our investment activity for the past 6 months, so just say year to date. Quite different than our commitments in 2015. We've committed to about $1 billion in 5 different investments during 2016. And let me kind of contrast, right, the characteristics of those investments compared to what we were doing the year before. So 2015, we made a lot of investments, and a good portion of them were pan-European, which, fingers crossed, since they have a 3-year investment period, they're kind of taking their time figuring things out with the Brexit. But let's kind of look at what we've been doing in the past 6 months, and I would say we've definitely turned inward. We're looking to protect our downside, looking to preserve that capital. And so how do we do that? We basically kind of look out and see whether or not our existing partners are in the marketplace with a product that would be a good fit for the portfolio. Why? Because they're tried, true, tested, usually with a first or second quartile performance. Usually with a low loss ratio, because you're interested in people that perform and you're also interested in people who don't lose you money. And so your lens gets particularly more narrow to try to identify those opportunities. So of that $1 billion, there's at least 2 of them were re-ups. And another interesting characteristic is that 2 of the investments were debt-oriented. And why is that interesting? Because primarily we are a private equity real estate program. Why are we looking at debt? Well, there's a great deal of uncertainty. So low interest rates are great. There's a lot of things that are happening that are great. But there's a lot of uncertainty, and particularly with real estate, which we know is a cyclical business. We're on a 7-8 year ride. And as we kind of turn around the corner, it's more likely that there's going to be a slight bump than not a bump. And so, debt is appealing because you have the opportunity to make equity-like returns and protect your downside more. So I would much rather have the systems in a position where if valuations start to get rather shaky, that there's a borrower with the first 20%, 25% in than us. So debt is playing a more dominant role in some of our recent investment activity. So re-ups with long-tested partners that deliver performance over cycles, risk mitigation strategies such as debt, substantially U.S. That's the direction that we've been taking the past year.
Thanks, Yvonne. Petya, it's interesting. Scott, in his remarks earlier this morning, I think characterized for this audience the pension plan certainly in a unique way. Since I've been here the last 4 years, and we've been here about 4 years together, and that is giving an insight to all the managers here as how do we think about growth assets, inflation hedging assets, and deflation hedging assets. Looking at infrastructure and the role that it's supposed to serve in the plan, how are you thinking about some of those macroeconomic issues and challenges that we're having as to how you're deploying capital and infrastructure types of managers that you're looking for in strategies?
So that's an interesting question because you're right. Some of the macro variables have a direct impact on the infrastructure program. Definitely infrastructure properties and linkage to inflation is something that we like about infrastructure. But what happens when inflation is not there and actually you have deflation? So what we have done, and this has addressed a few of those macro variables, not only the inflation, but growth as well, is that we have focused on managers that not only provide these contracts and have the core characteristics of infrastructure, but they also have a strong operational component. And what this means is that they do add value to these assets, and they're less susceptible to these variations in the macro environment. If you look at our portfolio and how it has performed so far, and absolutely it's early stage, it's still a small portfolio, but we are around 10 to 11% net IRR over a short period of time. And if you compare these to inflation, and that inflation has been actually going down, I think it's a very strong performance. So to really briefly sum up, we just look for managers that also add a lot of operational value.
Thanks, Petya. And Wesley, you straddle sometimes, between the public fixed income world and Mike Haddad and certainly the private markets, and come over to the dark side often. Tell us about how you're thinking about the world, and importantly, where are you focused and where you're looking to deploy capital in this market?
Sure. I mean, this is not a profound statement, but since the global financial crisis, I think it's pretty easy to assess and to conclude that we're basically in uncharted territory. So given that we're in such an environment, I tend to be a little skeptical when it comes to strategies that are based on historical mean reversion relationship assumptions, and this includes strategies with implicit assumptions on commodity prices as well as the timing of the credit cycle. So for the past few years, we've been focusing on establishing separate accounts that allow our managers to be nimble, to be thematic, and to be liquidity providers. We're also trying to focus more on special situations across geographies, capital structures, and strategies, and of course, uncorrelated cash flow investments not dependent on broader public markets.
Thanks, Wesley. And for PE, private equity, no surprise, certainly a lot of caution from me, from the team, from our consultants. We're taking a cautious look with buyouts, certainly given where asset prices are today, but we will continue to maintain our exposure there, just given that it's the largest sub-asset class or subsector of private equity, but being very thoughtful of the commitments that we're making in this environment in buyouts. I think where we are looking to be tactical and lean in with best-in-class managers is going to be special situations and turnaround. As you know, in private equity, we are committing over a long investment period, and while we've been saying this for a couple of years now, we do believe that over the next 5 years or so, there should be dislocation in the market, which our best-in-class managers in turnaround situations should be able to take advantage of for the benefit of our systems and our beneficiaries in terms of returns. I think also, as Scott mentioned and I think clearly showed in his graphic, in private equity, we have a lot of managers. And while we love you all, we can't love you all equally because the returns are not all equal. But in kind of all jokes aside, we are looking to be very thoughtful and continue to be thoughtful about concentrating our portfolio and trying to really do that with our best-in-class managers from small to large. We have a dedicated, as I said, emerging manager program, which will continue, but we will be thoughtful there as well in trying to be more narrow with our best-in-class managers like we will with our larger size managers. I know we're being a little stressed for time. I guess one more question for the panel, because I do want to get to our consultants. And Petya, I will start with you on this one. And really a general question for you, if I may, importantly. Either when you look at either the macro environment or something specific to your portfolio, are there any issues, challenges, kind of areas of focus that you'd like to discuss this morning?
We talked about the macro a little bit, so I'll stay away from the macro, but I would echo the theme of assets being fully priced. So as I look ahead for the next few years and how we would be investing, I think that we would continue seeing more capital flows to infrastructure. We are already seeing that, especially from US investors. They're either new allocations or increased allocations. And that's in addition to what is already a very active market for the Canadians and the Australians. And I would say we also see some Japanese investors that are allocating to infrastructure, and there are a lot of assets there. So I think for infrastructure, what would continue happening is more capital flows, what would in turn lead to even more competition and for assets. And that's why I think we would need to be extremely disciplined and continue to look for managers that have a specific angle, either operational, as I mentioned before, strength, and or proprietary deal flow, so that we can avoid the situations where it's purely supply and demand competitive situations. And I would say that because of these capital flows, we are also seeing new managers emerging. So there is new fund creation, which is great because it does increase the universe of investable opportunities for us.
Thanks, Petya. Wesley?
So, given that we're opportunistic fixed income, we're having lots of conversations with managers on strategies that are more thematic. And so I think I'll just mention some of the trends that I've been seeing in the last year or so, not in any particular order of preference or any preference whatsoever, but we've been having conversations on specialty finance lending companies. We've seen more unitranche lending on the direct lending side. Some of this will come as no surprise to you. Larger funds are being formed now to invest in second lien and mezzanine. Healthcare-related royalties, we've seen risk retention strategies, generally managers ramping up for what they believe is the upcoming capitulation in the credit cycle. A little bit older is European NPLs, but still out there, of course, and aircraft leasing, both whole and in parts.
And Yvonne?
So just building on the observation that Petya made about a lower return expectations, that's certainly something that we see in real estate. As I mentioned before, and as you know, it's a cyclical business. We're in the 7th or 8th year of a very, very robust recovery. And we are entering a stage where I wouldn't necessarily call it a downturn. I would definitely call it a reversion to the mean. Some folks kind of refer to it as the new normal, but actually we're just kind of moving toward what real estate has done historically. You got a 30-year return of about 8% on a net basis, and right now, certainly in core real estate, we're south of that. But yet, there's still the fundamentals are still very, very strong. We still have very, very low historical on this supply side. We have very healthy demand, probably more than we'd like in certain pockets of the market. So we just have to be disciplined. We're being disciplined, and certainly we want our managers to be disciplined. That's why we chose you. And so as we kind of walk down this road toward more normalized returns, I think if we all maintain that discipline, it'll work out fine.
Thanks, Yvonne. And probably three things I'd like to touch on, and frankly, it applies to all of private, but important commentary to leave with you. First of all, New York City has an increased focus on operational due diligence, is what I would say. When I think about what's changed the most in our underwriting process, from PE to private equity to infrastructure, OFI, all asset classes, is our focus on your middle and back offices. And we actually need and require you to have institutional quality back offices. We are looking and have done a bit of our part and are working on our part to strengthen our home team in those areas. Over the last 2 years, we've hired a head of risk, which is Miles Draycott, which many of you either have met or have spoken to, but he's here in the room today. And we've also brought on board Sachi Bhatt, head of compliance. Very important area for us. I know you've seen it yourselves in the questions you're getting for us. There's a true focus on operational due diligence, and I urge you managers that are raising capital today from New York City to be thoughtful in strengthening those areas of your organization. As you heard from Scott, there is an increased focus on transparency, and it's not just lip service. You saw the email that went out and correspondence that went out in the fall of last year to all current managers that we were adopting the ILPA standards for capital call and distribution notices. That was subsequently followed by an email in the beginning of this year where we've adopted the reporting standards from ILPA, and they're a requirement. It is important for us to have as much visibility into our funds, frankly, and how fees are being spent, and we are looking for increased transparency. And what we've said, and I'll reiterate today, is that we're making compliance with those standards a condition precedent for securing future allocations from New York City. I think lastly, I'd like to mention that we also have a laser focus day in and day out, and we're reminded of this every time we meet our boards every month about delivering the best fee structures for our beneficiaries here in the city of New York, and particularly in this asset class, in the private markets asset class, the most expensive asset class in our system. So you will continue to hear from us very vigorous conversation to get our fees down, importantly to get your fees down. We appreciate your cooperation in that area. Now let me turn to process, because I think this is important. Obviously, you're here this morning to learn about us. Scott Evans gave a great presentation about our plan, but ultimately is about raising capital for your fund, which in turn are going to drive returns for our beneficiaries. I will say that in the private asset classes, it is important to note that the four of us here really lead the underwriting process for our private markets managers, working very closely and side by side with our consultants that you see here seated in our front row. We're a little pressed for time, so in our networking session, you will have an opportunity to meet the four of us, our teams importantly, and will understand how to reach each and every one of us so that you can get on our radar and in our process. But I think importantly, what I want to do is turn it to the consultants. I remember starting here 4 years ago And one of the things that we wanted to do in terms of enhancing our relationship with consultants, and importantly, your relationships with consultants, is really driving this concept of what we call the multiplier effect. We are not satisfied with our best-in-class managers just securing capital with New York City. We're actually invested in your success and in your realizing your fundraising goals and really leveraging these consultants and all of their other clients to be able to raise your funds. So with that as kind of a backdrop as to where I want to take this conversation, one of the things that I hear in my travels very often, and particularly with emerging managers, which is very important to all of us, is that consultants, either perceived or sometimes based in fact, are perceived to be sometimes an obstacle to fundraising. And they themselves make it tougher for the smaller managers who may not have all the bells and whistles, the resources, as Mike Haddad mentioned in the prior session, to be able to market in the same level of force of some of our larger managers. So my question really begins for our consultants about how do emerging managers really penetrate your processes and get to your buy list and really stand out in a crowded field to be able to access capital not only from New York City, but from your other clients. And I will start with Steve Burns and Townsend.
Thank you, Alex. Can you hear me? Wow, this is a very large room. I hadn't noticed. The process is intended to be open and fair, and the process is intended to facilitate the inclusion of emerging managers at all times. That said, it is more difficult, and it is a competitive market. Most recently, I looked at our databases, and I don't know that it would probably stun most of you to know that there are 1,041 different real estate investment offerings of one type or another. So how then do you filter through this? Obviously, there's a process. We count on, or try to have, I should say, an informed perspective that is global and 30,000 feet and comes down and becomes more granular. So like every other manager, an EM is going to have to show that it has a great strategy. It's going to have to show that it has a good track record. It's going to have to show it has a fiduciary culture, et cetera. How do you stand out? A lot of it can be client-driven. There are many different clients who are always perpetually asking, can you include these different types of managers in our searches? And we are always trying to do that. In fact, our databases and processes enable managers to participate, and there are different triggers, shall we say, of inclusion that will show us when they are actually involved and when they're in our databases, et cetera. So open, fair, transparent. More difficult? Sure. It's more difficult for any company that is starting. That said, we have endeavored, and I think successfully so, particularly in New York, to be inclusive, and I think we've done a very fine job, actually, collaboratively, in getting to some great EMs, and we continue to do so.
Thanks, Steve. And the next question will be for Bill Foster with Cortland. Kind of on the same theme, we hear it often that it is more difficult for emerging managers to break through. We kind of get it to a certain extent. It's less proven to a certain extent than more established managers. But let me ask you, Bill, if I may, how does Cortland make it less difficult for emerging managers to break through?
Thank you for the question, Alex. I'm going to build somewhat upon what Steve Burns from Townsend said a moment ago. It's without question that it is more difficult for a firm that may be raising its first or second fund with a couple $100 million under management to get the traction that somebody who's been around for a long time has. It has become, more important in the marketplace for our firm and for our clients to begin kind of bifurcating the small and emerging managers and at least giving them a very thorough look, because if you throw them into the mix with, again, a firm that may be 100-fold the size, they're not going to get a fair look just if you look at the quantitative metrics alone. So in the past roughly 18 months, we hired 2 people whose really sole focus is to focus on emerging managers. We've met a lot of emerging managers. We try to have an open door policy. It's difficult because we have about 600 meetings a year between our 3 offices for all different real estate strategies, be they established or emerging market firms. So we try to have an open door policy, and we try to welcome everybody in. Sometimes we have more meeting requests than we do have people in the office at that period of time to actually take the meetings. But we have an open door policy as it relates to, please come in, tell us your story, tell us about your firm and what you do. We attend conferences and forums that are really specifically designed to connect the small and emerging managers with consultants like ourselves so that they can get in front of us better. And then again, I mentioned a moment ago that we hired 2 people whose really their job is to vet through these emerging managers, hopefully help bring them on board and see them become a non-emerging manager as they grow in size and perform for us. And what we've done is we've created a separate database where we track all of the offerings in the marketplace that are through emerging managers, and we combine them with the non-emerging, but again, we have them segregated separately, so when an opportunity or a mandate comes up for a smaller emerging manager, we have a better opportunity to really identify the best in class and take them to our clients for consideration.
Thanks, Bill. And the next question from Mike Koenig with Hamilton Lane. So Mike, you hear Bill mention that he's seeing 600 plus managers a year, emerging managers. I know Hamilton Lane is seeing hundreds, not 1,000 managers a year, and actually a small percentage of which actually get an ultimate allocation. That is true in all of our portfolios. Can you provide some advice as to maybe the don'ts and kind of the things not to do if you want to emerge from a top of the funnel that's almost 1,000 managers?
Sure. Thanks, Alex. I would say that the first don't is don't just focus on the quantitative component of your track record. I think one of the things that is really interesting about this part of private capital is the ability to really affect companies fundamentally. And so having a story about how you've done that in the past is incredibly important. Putting that into strategy is for us as important as the requisite track record and the quantitative numbers that you have. The other is be communicative. I think that we feel that we are that way. We need the same from you. Keep us updated as things change about your organization, your franchise, and your business. I think for us that's a very important piece, that we know exactly where things stand throughout the fundraise and throughout the development of your franchise.
Thanks, Mike. And also, Mike McCabe, Hamilton Lane, maybe take the other flip from Stepstone, take the other side. It's Mike and Mike. I apologize. Mike McCabe from Stepstone. The other side of that, what are some best practices that you can share with managers, emerging managers in particular, to help them break through, but also break through with other Stepstone clients?
Sure. Thanks, Alex, and thanks to everyone for being here today. I'm Mike McCabe, one of the senior partners at Stepstone, based here in New York City. So we get this question a lot, and how do you get through the process, and how does the process work? Well, first, I think it's important to note that the funnel that we use and the process that we apply is the same across the board, regardless of who the manager is. We too see about 1,200 PPMs a year. We take about 700 meetings a year. It's an open door policy. The important thing is we use the same process for one important purpose. All of our clients across the entire platform get access to the same information. And so if a manager gets through the funnel, they get the benefit of consideration across the board, which speaks to the point that Alex had raised earlier, which is this multiplier effect. The result would be if the investment works its way through the diligence process and ultimately gets acted upon, chances are good it will not only receive a commitment from New York City, but 1, 2, or maybe 3 other clients as well. That just further bolsters the strength and longevity of that particular partnership. So the process is the same across the board, certainly in the front office aspect of Stepstone. In the back office, where we monitor, report, track, keep on touch, and try to add value where we can, we do we do track the emerging managers separately so that we can understand how the performance of the overall program is going, and more importantly, see how we can graduate them into the core program as well.
Thank you, Mike. And now just quickly on our alternative credit managers. I'll start with Callan and Bud Pellecchia. Anything different, I know you were on the prior panel, about the process for alternative credit managers from what you've mentioned earlier on the public fixed income side?
Yes, Alex, it is different because in the opportunistic fixed income area, we don't typically use the search process that I described before in the public markets. We exchange ideas between Wesley and his team, and we're continually talking about themes that are bubbling up in the marketplace and which of the managers are executing best in those areas. So it follows more of the alternative space search process or idea process that is different than what we do on the public side.
Thank you, Bud. And lastly, Rokutan and Robert, maybe anything you can share about the Rokutan process. You know, how does it begin, the length of it, and certainly how do people reach you and your team?
So as it pertains to the opportunistic fixed income program, because it does span both public and private markets, things that apply to comments about utilization of the eVestment database, for example, do apply in certain instances where the program touches on public markets. Those mandates tend to focus more on dislocations or sources of inefficiency in traded securities. But it is more of a manual process, as Bud mentioned. So it really is about being communicative about both the qualitative dimensions and this can really differentiate, and I think we would both agree that the emerging manager in the program today really did stand out in terms of the distribution of equity to principals at the firm, the alignment of interest in terms of the terms of its funds with limited partners. Those qualitative dimensions can be a differentiator for a firm that is less established. But beyond that, it really is about being very clear with the themes and the market opportunity you're targeting and whatever your edge is. We do about 750 meetings a year as well, and about 60% of those are with new managers. So we endeavor to and do track emerging and women and minority-owned businesses as a part of that process, and it really is about persistence.
Well, thank you, Robert, and we look forward to meeting each of you that have further questions at our networking sessions here on the second floor and then the 19th floor. Do we have time for a question for private markets? I hear one question for the private markets team. Well, once again, thank you so much, and look forward to catching up in the networking session. And now we're just going to roll right through, so I'd ask you to please stay in your seats. I'd like to bring up Mr. Michael Garland, who runs corporate governance, assistant comptroller in corporate governance and responsible investment.
Good morning, or actually good afternoon. So I'm mindful of the fact that I'm the last thing standing between all of you and the networking sessions with the asset class team. So in deference, I try and get through my 2-hour presentation in about an hour. As Alex mentioned, I'm Mike Garland. I oversee the Corporate Governance and Responsible Investment Program. Our mission, let me go right into it, dive right in. Our mission is to protect and create value through active share ownership, primarily in the public equity portfolio. As John Merseburg mentioned, domestically, the portfolio is overwhelmingly passive, so some of you may buy and sell public equity securities, but our funds are going to be long-term owners of virtually every company in our portfolio. We have the Russell 3000 plus just domestically. Globally, we have over 10,000 public equity portfolio companies. And there's a long history of active engagement with the New York City funds, a long and proud history. Our program, our responsibility is to strengthen corporate governance and share owner rights through active engagement with portfolio companies and to promote sustainable business practices. We have an 8-member team, I think most of whom are here today, all of whom have probably, I think, at least 10 years experience. So we have a very experienced team. Just to summarize our primary responsibilities, we oversee the proxy voting policies for the funds and implementation. The implementation side today is just with respect to the domestic portfolio. Currently, our non-US managers vote those securities using the fund's proxy voting guidelines. We engage our portfolio companies and advocate for governance and other reforms around sustainable business practices. We are very active around institutional investor collaboration. Scott Evans mentioned it with respect to how he talks to his colleagues. On the corporate governance front, New York City was a co-founder of the Council of Institutional Investors. We're very committed to formal collaboration as well as informal collaboration. Helped co-found Ceres, the investor network on climate responsibility, and it's a big part of our program. More recently, we've been working to collaborate more closely with some of our non-US colleagues, particularly the European pension funds. We engage regulators and advocate for regulatory reforms to protect investors and ensure a focus on markets that focus on long-term value. And then we're a resource to the trustees and across BAM on responsible investment strategies more broadly, and I'll get into a little of that later on. 2016 was an impactful year, I'd say, on all counts in terms of responsibilities. Our funds enacted new proxy voting policies and guidelines. New York City was among the first systems in the country to enact proxy voting guidelines in 1987 and to take back voting authority. Those guidelines have been updated every year, so they weren't stale, but they were very granular. You could infer a philosophy, but it was never explicit. And what we did is we did a complete overhaul so that we could articulate to the world, to portfolio companies, to our participants and beneficiaries, how we view governance and what our expectations are of portfolio companies. And for the first time, those are broadly disclosed. So those are available on our website, and the teacher's version is available on the TRS website. Those new guidelines, I want to be clear, we've maintained the philosophy and approach, the longstanding approach that the systems have had with respect to independence and accountability at the board level, aligning pay with performance, and promoting sustainable business practices. And we've addressed some leading issues that we've added to the guidelines around board diversity, for example, where we've explicitly defined diversity in the boardroom to not only be explicitly race and gender, but also out LGBT directors, and address a number of other new issues. This is our overall summary voting performance, 2016 through 2015. The new guidelines were put in place just before the 2016 proxy season. You can see that the numbers didn't really move around a lot. I think that shows there's consistent application. So just in fiscal 2016, our team voted on over 30,000 individual ballot items at over 3,500 companies. We supported directors about 80% of the time. We supported compensation about 65% of the time, which if you think about the inverse, we opposed management's say on pay vote about a third of the time, which is significantly above what the proxy advisors and frankly what most of you are doing, I think, in your voting practices. Last bar over there, we're generally very supportive of other shareholder efforts to impart reform through shareholder proposals. So we support shareholder proposals about 90% of the time. That number moves around a lot because year to year the population of proposals can look very different. But proposals are also a very important tool for New York City. And we were, again, one of the first to file proposals from the institutional investor perspective, dating back to about 1986. And the controller talked about the Boardroom Accountability Project in his remarks, so he stole all my thunder. But I'm going to talk a little about it in more depth because that's really an effort to take capacity that is relatively unique here and to do something very meaningful with it. And that's really been our top priority for the past 2 years. The Boardroom Accountability Project is an ambitious effort to enact proxy access across the U.S. market. Proxy access essentially means giving investors the right to nominate directors and include those nominees in the company's proxy statement. Today, that right exists as of right, through regulation in most developed markets. The SEC has proposed a rule twice in the past 15 years, once following the collapse of Enron, and the second time following the financial crisis. They actually enacted a rule in 2010, but because of stiff business opposition, the Chamber of Commerce sued the SEC, vacated the rule on procedural grounds, and so investors were left without access in this market. We keep hoping for a rule, but finally I think what we've done under the controller's leadership and the trustees' leadership is we said, let's see if we can go company by company, but on scale. And we reached out and we built a coalition with our peers and many of the other largest pension funds in the country. And we submitted the first year, so this is going back 2 years, proxy access proposals to 75 companies. And we requested terms that were identical to the rule that was put in place in 2010, briefly, by the SEC. If you've held 3% for 3 years as a group, you have the right to include up to nominees representing up to a quarter of the board in the company's proxy statement. We picked our focus companies based on 3 fundamental concerns and areas of risk. One is boards that had inadequate board diversity. Second is companies with a history of excessive CEO pay that not aligned with performance. And the third was our most carbon-intensive energy companies where there's particular risk with respect to carbon risk. And I think particularly now coming out of the Paris Agreement earlier this year, a focus on climate-competent boards. This past year, we added one more basket, and that was our largest portfolio companies, regardless of their performance, their governance, their risk profile, because the empirical research on the value of proxy access. When we launched the Boardroom Project on November 6th, 2014, we made one public announcement in one day about 75 companies. That allowed the economic researchers at the Securities and Exchange Commission to do an event study on the impact on the market. And they concluded that, now this is the expectation or the possibility of proxy access at those 75 companies had a 53 basis point positive impact. Now, we're not necessarily creating value, that was sort of a market expectation, but that number was consistent with a study put out a year previously by the CFA Institute that said if we had proxy access across the market, it would increase market cap here in the US by as much as 1% or $140 billion. So when we launched, there was quite a bit of opposition. Boards don't want to allow, this is opening up the boardroom. It's changing the power relationship between shareholders and the directors that we elect, ostensibly elect. So in the first year we did this, we filed 75 proposals and we reached negotiated agreements with 7 of those 75 companies, which is not a particularly impressive settlement rate. And it reflected the deep-seated opposition. Most of the proposals went to a vote. They averaged 56% support. It sent the message that the market and investors have real conviction about access. I should mention, by the way, those votes are over management opposition. Flash forward a year, we filed 72 more proposals, and we settled 72% of them. So in the past less than 2 years, I think what has happened is investors sent a strong message. I think boards get it. Their investors want access. Where the proposals aren't opposed by management, they get over 90% support. And I think directors recognize increasingly that the sky's not falling. It's a very powerful right, but it's not easy to use. It includes safeguards. It's not going to be used frequently in any circumstance. The power of it is the possibility or the specter that investors could use it if boards don't move quickly enough to add diverse directors or address other concerns or risks. The impact on the market, as the controller mentioned, has really, it's been astounding. As Controller Stringer mentioned, when we launched, there were 6 companies in the US that had meaningful proxy access bylaws. Today, and when I say meaningful, that's for a group of 3% shareholders. Today, there are 259 companies by our count. There were efforts to try and deflect these proposals with some companies adopted bylaws requiring a 5% group. If you're sort of wonky like me and in the weeds, the difference between 5% and 3% is huge. 5% is the illusion of proxy access. It's unattainable. The Boardroom Accountability Project's our signature initiative. It's using most of our capacity, but we are doing a number of other things. I'm not going to go through each one, but just to give you a flavor of what we've been doing in 2016, advocating for diverse and climate-competent boards, promoting disclosure of workplace and supplier diversity, enhancing corporate political spending disclosure. We have an initiative curbing human rights abuses in the seafood supply chain, specifically focused on slave labor in Thailand with respect to shrimp, and challenging excessive CEO pay. Some of these initiatives we have advanced through shareholder proposals, not all of them, but some of them. Every year, before proxy season, we give a survey to our managers that tells them all of the proposals that we have going forward to a vote. And it serves two functions. First of all, if your staff is going to be voting on them and wants additional information, we want to be able to make the case why we think you should vote for them. Because remember, we're voting our shares, but we care about how our managers vote those shares where they have discretion. And then we come back at the end of the season and we ask you to complete the survey and we monitor your voting. It's voluntary. You're not a voting fiduciary for us, but typically participation is very high. And we don't ask for that until August 30th, so if you have mutual funds under management, you're required to disclose that information by that point. Anyway, if you haven't already sent your completed survey in and you're a manager, please do as soon as possible. Finally, just looking forward, some of our current priorities and projects. Global proxy voting alignment. I mentioned that currently we only vote domestic proxies. Over the course of 2017, we expect to take in-house the 6,500 or 7,000 companies' proxy voting responsibility. That will do a number of things. It will allow us to ensure that all votes cast at a particular company are cast consistent with our guidelines and consistent with each other. So we don't have the risk that different managers will vote the same security in a different way. Our board's issued an RFP on climate change. It's a two-part RFP to both perform a carbon footprint of the portfolio and to provide climate investment consulting to help our trustees and BAM think through how we respond in terms of our investment strategy and allocation. I want to acknowledge Jimmy Yan, who's special counsel to our chief investment officer, not actually on our team, who's really taken the leadership in BAM in getting this done. And then finally, we're going to keep moving forward on the Boardroom Accountability Project. In closing, I was thinking today is actually my 6th year anniversary with the Comptroller's Office. And the corporate governance program is one of the areas that I think there's quite a bit of pride over the years. And it was really an opportunity for me to join a place 6 years ago that was proud of its leadership. And I think that what we've been able to do over the last 2 years is up there with some of the most significant things the systems have done over the last 30, particularly the Boardroom Accountability Project. So I think when we talk about building a stronger future, I mean, we are delivering for our participants and beneficiaries, and I'm proud to be a part of our team and have the support of both Scott Stringer and Scott Evans. It's really been a good run. So thank you, and upward and onward. Oh, I should be handed back to Carl Wallace.
Yeah.
Thank you.
Well, thanks to all of you for staying through the entire event. But guess what? Your peers may have gotten a jump on you for the networking session because most of the sessions are up on the 19th floor. Over in room C, we're going to have infrastructure, our economically targeted investments, and real estate will be right next door. Otherwise, private equity and all of the public markets are up on the 19th floor. There's some snacks for you outside, and then head on up. Thank you again for coming. We appreciate you.